All right, good morning. Today's Wednesday. We're in week 5, and we are covering job order costing. And notice that we have a discussion activity, homework quiz bonus for this week. What I did do was, just like I did with Chapter 11, the Chapter 11 activities, I actually was going to have the discussion due as of last week, but I just went ahead and changed the due date to this week just in case not everyone had a chance to do that, or if anyone was unclear. I guess I should maybe make this a bit clearer there. Sorry about that. Or if anybody was unclear about what the revised due dates were, rather than have it for certain activities for Chapter 11, I thought maybe just push everything to the 29th for all activities. So if you haven't done the discussion for Module 11, Chapter 11, you can do that up through Sunday, so you've still got that opportunity to do it. The sooner people post to that, the quicker that everyone can make initial replies. And so we don't have a due date that's advanced or stepped up beyond the other due date, the final due date, which means that if everyone waits till Sunday night to make those posts, you're going to find a lack of posts to reply to. So I'd sort of urge you to do that sooner rather than later. You're going to do it anyway. So, and I wouldn't put a great deal of thought into it. Probably shouldn't put it that way. I wouldn't put a great deal of effort into research and citing and whatnot, but I would just reference the course material to the extent that you can. So Chapter 12, I deferred everything to the 6th of October. And so if you look in Brightspace, and I'll just pull up Brightspace here real quickly before we get going, you'll notice that, oops, wait a minute. You'll notice that I have deferred the activities until October 6th. It's Chapter 12 discussion, October 6th, Chapter 12 homework, Chapter 12 quiz, and Chapter 12 bonus. So you've got an opportunity to do that. Now, one thing I should point out is we have an exam next week covering the first 3 chapters in the course that we've covered, chapters 10, 11, and 12. So that's coming up next week, so don't forget about that. And I know that I think sometimes we're a little bit reluctant to have too much due in one week, like pushing this forward. I think part of the logic of having it due week 4 is, it's so that you're not bogged down with too much work to be done in the week of an exam. However, we're still going to be covering Chapter 12 into next week, week 6. So to me, it doesn't seem like there's any reason not to allow that extra time. And if you want to work ahead and do that now, do that work now, you can certainly do that. You want to give it a try now and think, hey, I want to study more, read more, hear more from the instructor, that's perfectly fine too. Okay, so those are the upcoming activities that we've got going on here. So what I wanted to do was pick up from where we left off on Monday, talking about Chapter 12. We've got a number of people on the live Zoom link. Anybody have any questions for me or anybody in the classroom? We have one person in the classroom and a number of people on the Zoom link, and feel free to, if you have questions, you can give me a shout out. Otherwise, or you can put something in the Zoom or the chat box as well. I'm trying to get the captions to work, and it sometimes works and sometimes doesn't work, and I don't know why this is not always working. Sometimes I have it, sometimes I don't. It looks like I've got everything prepared correctly, but it doesn't appear to be working. So anyway, maybe I'll have to look into that a bit and see what's going on. So, and if anybody does need captions, I think we can go back and recaption this if necessary. So, okay. Well, I think we left off. We had just gotten into the beginning of Chapter 12 on Monday. I'm just going to go back just a little bit here in order to go forward. And we had covered most of the class session on Monday. We did some example problems and exercises from Chapter 11, and I tried to select sort of a selection of exercises that I thought would be pretty representative of what you might see in the homework quiz and bonus for Chapter 11. And if there are others you want me to work, I'm certainly glad to do that. I actually had planned to do more, but I think that some of them, as I got to looking at them, kind of appear to be sort of overlapping in a lot of ways. So let's get into Chapter 12. Chapter 12 deals with job order costing. And I'm not going to go back all the way to where I began, but we didn't get too far into it. And one of the things I wanted to mention was the idea that when we talk about job order costing, the important thing to know is that we contrast that with something called process costing, which is a method of costing for mass production of goods, wholesale or retail delivery, but typically we think of retail goods, whether it's things like tubes of toothpaste, bottles of shampoo, rolls of paper towels, things that are all the same. In other words, they're all homogeneous within a particular class, or in very wonky accounting terms, SKUs, which are stock keeping units. They're all the same. Everything is identical, and so we produce in huge, big batches. And sometimes we might do the costing of that based upon a time period, where we simply say from January the 1st to January 31st, we're going to get the cost for the production of those goods. We're going to dump them all into product cost, into inventory until they're sold, and that's the way that we account for those costs. Or we can do it by production run. Some companies that are in manufacturing will do a run of something. Maybe it's Colgate doing toothpaste, and they'll produce all regular toothpaste for a couple of days, and then they'll retool, switch over, and then do the mint flavor or whatever. I mean, you get the idea. There are all kinds of different types of SKUs, different kinds of variations by size, by flavor, by whatever. And so process costing is really good at capturing that for a specific batch or time period, okay? And it's for goods that tend to be homogeneous, and by homogeneous, I simply mean that one good is identical to the other. And the example that was given in the text was this idea of potato chips. And now this is a pretty extreme graph where they take the processing of the good all the way from raw material, and by raw material, we really mean raw material, potatoes just harvested. And that's probably not terribly realistic. I seriously doubt that Frito-Lay actually grows potatoes and takes them all the way to potato chips. They might, I don't know. I know McDonald's several years ago tried to do something like that, where they had cattle ranches in Guatemala, somewhere in Central America, and lettuce farms in California. And I don't think they do that anymore. And there's a rule of thumb in business that if there's somebody else who can do something in that chain of value, that you should let them do it, even if maybe you do grow the potatoes, but then you don't do this part here, and you send it off to somebody else, and then they send it back to you. It's all got to be done, and so whoever can do it better, cheaper, and faster will do it. Now, process costing captures this in ways that are very similar to what we talked about before. That is absorbing the cost as we move down the chain of production, okay, all the way to finished good. Anyway, we talked about that on Monday, and so where we want to pick up is this. And we had only, I had only really gotten into job costing as sort of in definitional terms of what it was. Among the differences between job order costing and process costing is the idea that job order costing deals with unique outputs. And we're not talking about mass production, we're talking about a few bits of production, all of which can be delineated from each other by the type of output it is. And just as an example, you could be a remodeling firm, and so you might have a custom kitchen remodel over here. You might have a gazebo you're building there. You might have a deck construction. These are all different projects, and they're probably going to involve lots of different inputs as well. I mean, the things you're going to have for kitchens, like new sinks and cabinets, are going to be different than what you're going to have for a garage rebuilding. Clearly, I think we all know that. But the point is, though, they're going to have different time frames. They may involve different work crews. You may have different subcontractors who are involved. And so the point of it is we're talking about unique outputs. And the idea is, okay, given the fact we've got each unique job or even batch, whatever it happens to be, if it's unique, then we want to cost that not by time frame, as in process costing, or not by production run of the same item, as in process costing, but by the individual job itself. And so you're trying to capture all the costs which are applicable to that job. And there are a lot of different reasons why you want to do that. One big reason that sort of comes to mind is the idea that you can better price your output, excuse me, if you know what your inputs cost. Remember, we talked about this very simple model. Inputs create costs, outputs create revenues. And so obviously you want the value of the outputs, i.e. the revenues, to exceed, to be greater than the value of the inputs, the costs. Otherwise, why is it you're doing what you're doing? So you're trying to maximize profit, you're trying to maximize that distance. But how on earth do you know what the value of inputs are unless you're accounting for them in a setting in which you're doing unique jobs? Then you're going to want to compute the cost for that particular job and capture everything that's relevant. You're going to capture all the inputs, which are in fact relevant to that particular job. And remember, when we have, you probably got this in your notes somewhere, so I don't know that it bears, a repeating in the notes, but when we talk about manufacturing or production costing, we've got three major categories. We've got direct materials, we've got direct labor, and we've got manufacturing overhead. And the word manufacturing may be a euphemism for any sort of production, even if it's a service job. And so one of the outputs that we talk about in job order costing are things like motion pictures, which is particularly relevant to New Mexico since we are pretty heavily involved in film and television production. And I don't know that you could say that we manufacture a motion picture, but it's got similar analogies. I think we think of it as being entertainment, which is a service industry. It's not inventoriable necessarily, although you could argue that if you put it on your DVD, that's inventory. That's not even that much of a relevant topic these days. So manufacturing is sort of a euphemism for what we're talking about. Direct materials and direct labor are what we call direct costs. That's going to play a more important role here in a minute. And manufacturing overhead, or if you want to just go with the term overhead, we call those indirect costs. And remember, with manufacturing overhead, or overhead in general, which is a term we've probably all heard at some point before, it's got two main characteristics. Number one, the costs which are involved here are so unrelated to the job or the production at hand, it's really difficult to drop all those costs onto individual products and inventory them, which is what all these costs are. We say these costs are inventoriable. That is, we take their cost and we don't expense them right away. We put them into inventory, and only until we sell them and recognize their cost as cost of goods sold do they ever appear as expenses on the income statement. Again, the term cost and expense being interchangeable. So that's one characteristic. Either they're unrelated, so like security guards, plant managers, and the salaries we pay those people, quality control inspectors, that's difficult to sort of put onto every individual output. Or the costs of the materials are indirect, and they're so difficult so minuscule, often per unit, that it's impractical to cost them like, and paint is the perfect example. How much paint is lost is probably quite variable because a lot of goods are spray painted. And I'm sure there's a lot that's sort of lost, or drops of glue, or bits of adhesive, or waxes, or lubricants. I mean, it's all very difficult to compute. So when we talk about job order costing, we are not denying these three categories. We're going to talk about how these work as we get going here. So again, we're attaching these to individual jobs, not to individual time periods. And we're going to talk about what some examples of these are here in a second. So as an example of this, and I really like this particular example because I think it has particular relevance to what we do here in New Mexico in terms of film production. You've got two different films, same studio, two different films. One is the animated film, like, I don't know, Shrek or whatever, and another is an action thriller, of which there are many, of course. Well, look at the inputs, they're all different, right? With the animated film, you've got graphics people, computer programmers, you've got musical composers writing things, you've got voiceover talent. A lot of the big actors are involved in obviously animated voiceover their characters. These are different inputs than over here. When you have an action film, you got lots of stunt people, and you're on exotic locations, and you've got lots of physical people on set somewhere. So you've got catering trucks. You've ever done a movie set before? They don't want people to leave during the day, so they bring in food for them, and so as a result, we get caterers. All these are different, elaborate set designs, physical set designs, where these are different kinds of inputs for what would appear to be similar outputs, but they're different in the sense of the way that they look. So that kind of gives you an idea of what is going on there. Just as one example, just in order to, this is something I came up with, and you can, if you want to note these down, you can. But I've got a sort of comparing and contrasting of job order costing versus process costing. And again, we're not going to spend very much time in this class talking about this. If you go on to take further accounting courses, particularly in cost accounting, you'll probably get more into this. But we are going to cover job order costing because it is fairly unique and it covers lots of different types of examples. So one thing I said is that the prototype is more custom than mass production in the case of job order costing. Some of the examples are things like signs and buildings, and I even put tax returns in here. You know, a lot of, because it's a service, there's, you know, you pay an accountant $400 to do a tax return, you don't pay him for $400 of documents, you pay for the service that's being done. And so the concepts apply to the service sector as well as manufacturing. Any kind of construction sort of is tailor-made for this. And for those of you who may take intermediate accounting, the first of the intermediate accounting courses that we teach, which are pretty much the same everywhere, at least in the state, we have the same job description and, I'm sorry, the same course description and whatever. We will cover construction and the way that we absorb costs on a construction project as it's being done. And it may take a couple accounting periods, cross accounting periods, in which case we have ways that we can accumulate the cost by job or by job law. There is work in process in both cases, only it's evidenced here by what we call job cost sheets. We'll talk about that in a minute. And the term job cost sheets is probably a little bit old school in the sense that the physical, a sheet sort of implies a physical document. And obviously today, a lot of what we do is with software, and in a manufacturing context, a lot of supervisors will walk around with handheld devices like tablets and do things that they need to do. That is not even new, it's been around for a while, but we still use the term sheets, kind of like, you know, Google Sheets or whatever, or electronic spreadsheets, it's a euphemism. We have a separate work in process department that we would capture process costing in, and the record keeping is done with these cost sheets as opposed to a mass production cost report that's done in process costing. So the key thing is, what I really want to talk about here were examples. These are things that are more custom than you know, standardized. Customized goods, standardized goods. These are all the same for the most part. These are all different, and so they differ. So things like you know, auto repair would be an example of that potentially. I don't know that a lot of auto repair shops would use job order costing, but typically if it's a smaller business and it's hard to know what is being done there. But to the extent that they would like to capture and accurately reflect costs in the to each particular job, something like this would be used. So the flow of costs here looks something like this. Again, all these slides are in your slide package. They also parallel the textbook itself. Is that the costs parallel each other in terms of the physical flow of the materials. And one thing I wanted to show you, and I wanted to go back just a little bit here, because, and I want to go back to chapter 11 real quickly, and I think I could find it quickly enough. I know it's a fairly long chapter, but there was a slide there that I thought that sort of captured this, I thought, very well. And if I can find it here. So, and it goes something like this. We've got the physical production of goods, and you've got the accounting for the cost of those goods. And we can measure these things in terms of units, whether it's raw materials can be pounds or individual distinct units or whatever. Work in process inventory can be countable units of inventory, same with finished goods. But here, these are all dollar flows that go across. And so the idea is you want to parallel the physical flow of output with the accounting flow of cost. And the idea is to try to mirror that so that you are absorbing cost as things are being produced, as the thing is going up down production. And I'm not talking about production line necessarily like a production line, like for automotive or whatever. It's just, I'm talking about the chain of production, whether it's construction or home remodeling or whatever. You're going from start to finish. And as you go from start to finish, you're absorbing costs. And we still have in these three inventory accounts, we have raw materials, we have work in process, and we've got finished goods. These are kind of out of order here a little bit, but in fact, I don't even see raw materials here, but there is a raw materials. And again, the term raw materials, which is, I kind of think the example of the potato chips is not the best one because it sort of implies that we're starting with actual potatoes that just got harvested. And that may not be the case with any output, is that some of the output that we call raw materials are actually finished goods that somebody else created. It could include things like bolts and screws that are done somewhere. Obviously, those are not dug out of the ground or mined somewhere. They're manufactured, but they're raw to the firm in question. Okay. And so as we're absorbing costs, we are putting them into a work in process account. It's an inventory account. It's a balance sheet account. Again, we're not reflecting any cost on the income statement as a deduction from revenue until the goods are sold. Okay. And then when the goods are done, we transfer to finished goods. And and as those goods then are sold to a customer, again, reflected in cost of goods sold. That's the flow that's going on there. And that's not really any different at all than what we talked about before when we talked about in chapter 11, the sort of introduction to cost recognition. Okay. Here's an example. And the example we use here would be an item that is unique and maybe a little bit different, maybe even a little bit customized. Made to order, right? Made to order goods are almost always done with a process costing scenario. These are fire trucks, okay? Now, I think we probably look at fire trucks and think they're all the same, and we're going to assume that they're not in this case. So we've got raw materials, whatever they are. We've got things like, we've got just a ladder. Somebody had to make a ladder somewhere, but it's not, it's going to be part of the cost of this good. When it's done, it's going to be a fire truck with a ladder attached to it, and tires and a frame and all that. And as this is being assigned here, it's being used up, we're assigning it to work in process. And as it's completed, we take it out of work in process and put it into finished goods. And when we sell it, we take it out of finished goods and recognize the cost of goods sold. And the same goes with factory labor. We hire labor to put these things together. And as the labor is being incurred, we put those costs into work in process until that unit is done, that job, that task, that project is done. Then it goes into finished goods. And it may not be there very long at all. It's going to be a very temporary place. And then cost of goods sold. And again, cost of goods sold is really the end of the line for the accounting for that particular job. It's done. It's over. And we might assign a job number to it, which is never going to be repeated. It's going to be unique. We can always refer to it. We'll get to that when we start looking at these job sheets. And then the final one again, because we have direct raw materials is the same really as direct materials, to be honest with you. The one thing that may be a bit different is, maybe a little bit different is, we say that direct materials are direct costs. Raw materials may include some indirect materials, and factory labor may include some indirect labor. And to the extent that that may be the case, we're going to capture those here, okay? So that's the thing that we should know about. And we're going to spend quite a lot of time talking about what we do with overhead and how we accumulate it, how we assign it to individual tasks. And we've already talked about some of the examples of what goes into manufacturing overhead. Things like indirect materials, indirect labor, those kinds of things. And as we're absorbing those, we're putting them into work in process, and then when the good is done, it goes to finished goods and out the door to cost of goods sold. The key thing here is that we say that we assign these, or the term of art here is we apply overhead to outputs. And the issue of how we apply overhead is more of an estimated issue. And as we get going deeper into the class, we're going to talk quite a lot more about overhead, how we accumulate it, how we assign it, and all the different ways, or some of the different ways that we can account for overhead. Overhead's got some unique issues, but as we've said before, inventory itself has got some unique issues, and it's no secret at all to me, for instance, as to why a lot of companies don't want to have anything to do with inventory, would rather specialize in a service business, because for one thing, all these issues with inventory are gone. Now, we should mention though that like in either merchandising or manufacturing context, we've got sales minus cost of goods sold equals gross profit. The analogy to cost of goods sold in the service industry would be things like direct costs. Almost always labor involved in producing that. That's the big category there. There aren't typically as many materials. And we will bring in service examples a bit later. I know that I've said this before, but part of the logic of using manufacturing as the context for a lot of the examples and modules in this introductory managerial accounting class is that the very same concepts apply to service businesses as well. I would not go so far as to say that it applies to governmental accounting, so let's not quite go there, but for private actors who are profit making, a lot of these concepts will apply. Okay. All right. Questions before we get into some examples of some hypothetical numbers here for a company whose activities we're going to follow down the line. Okay. And you can feel free to use the chat box in Zoom. I'm standing pretty close by so I can see it. So feel free to do that if you like. And I'll get back to you as quickly as I can. Okay, we've got an example that your chapter has taken quite a long distance, and that's this company called Wallace Company. And I had a class yesterday. I was looking this over the weekend. I can't even think about what they're making, what the output is, but it doesn't really matter because right now we're mostly interested in the cost of inputs than we are outputs. And so here we've got raw materials. We've started with 0, okay, and they had bought 2,000 lithium batteries. Notice they've got a stock number that they have assigned to it as an inventory control measure. And by the way, this is an important issue that relates to job order costing. And that is the idea that companies' use of technology is getting better and better at tracking that, even individual, very small pieces of inventory, because they can be tagged and with all kinds of different things, barcodes, that we can scan, or the QR tags that we're all familiar with. Have kind of the crazy design on that we use our phones to take pictures of. That really started as an inventory control measure in manufacturing, and it's obviously made its way over to everyday life in the retail side. So anyway, this company bought 2,000 batteries at $5 a unit. So 2,000 times $5 is 10,000. And then they bought 800 modules of something, whatever it is, at $40. So that's 800 at $40 is 32,000. So 10,000 for the batteries, 32,000 for the modules, gives us 42,000. So what do? We simply book that into raw materials inventory. It's an asset account. It's an inventory account. It's current assets, right? It's going to be used to produce further outputs. Okay. So that's the beginning entry. And what we're doing here is we're sort of going through the process of acquiring inputs, costing inputs, putting them into ultimately to inventory accounts, and then eventually to including overhead, by the way, and or taking overhead and putting it into inventory accounts, and then moving it all the way out to the sale to a customer. Okay, so that's the first example was raw materials. Factory labor. Okay, so factory labor or any kind of direct labor that's involved in producing output is usually inventoriable if we're producing a physical output. And here the thing that we ought to know about, and I think it's important for us to understand this, is that it's not just wage per hour times number of hours worked, and then adding all the workers up. That is true, that is the case. But let's take an individual worker here, and we've got a wage, right? Let's say the wage is $10 per hour, which is probably the legal wage. Yes, it's below minimum wage, but it kind of keeps the math simple, okay? So you've got $10 per hour, so you got $10 times 40 hours per week is $400, right? But we have to account for other things that go into total compensation or total labor cost, direct labor that we want to inventory to capture within that particular output itself, that task, that job, that project, whatever. And it's all the other things. It's payroll taxes. Now, and these are employer payroll taxes. That's important to know. Payroll taxes are not income taxes. The worker may pay his or her own income taxes through withholding, and most workers do have at least some of their pay withheld for state and federal and state payroll income tax. Payroll tax is different. That's Social Security and Medicare. And Social Security and Medicare are two forms of taxes. They're both federal, and what happens is the employer and employee split these costs up to certain dollar figures in the case of Social Security. And for Social Security, it is, I believe, still 6.25%. And at 6.25%, that's paid by the employer and the employee. It's a joint cost, okay? And then Medicare is, I know, 1.45% with no cap. There is a cap for high earners where they quit paying Social Security, but they don't stop paying Medicare for earned income. Now, the reason I bring this up is because we're talking about the cost incurred by the business is the sense that the business will pay these costs. And whether the worker is full-time, part-time, productive, not productive, it doesn't matter, they're due, and the employer's got to pay them. The employee does too, but that's coming out of the employee's pocket, out of whatever else comes out. So payroll taxes have got to be captured. And then any other kind of benefits which may apply, such as we say sick pay or whatever. One of the things that is glaringly absent here is health insurance, which is a very big cost, particularly if you have coverage for a family. I mean, most workers pay thousands and thousands of dollars per year for health insurance. And I know here at CNN, our premiums go up the more we earn. So it's a tiered system. A lot of us pay quite a lot for family coverage. And that's a big one. And the employer pays a share of that as well. The employer also pays a share of that. And any kind of pensions. And pensions are not as common a thing in the private sector as they are in the public sector where I work, for instance. But pension costs are also shared oftentimes between worker and employer. And all the other costs, dental insurance, union dues, which are generally paid by, actually union dues are paid by the employee, but all these are added up. So, and I know that a rule of thumb, and it's not a perfect thing, but it's just an estimate. It's sort of those back of the envelope things, is that we would take the pay and multiply it by 40% or raise it by 40%. We would say the compensation to this worker for this week is not $400, it's $560, because we usually consider benefits costs and all the other employee-related expenses to be about 40% of the base wage that we add on top of that. So we multiply by 1.4 to raise that up to what we call gross it up. And that's the idea that we incur more costs than that. And then however many workers, you would add up all of that for the hours that are employed on that particular job, whatever it is. It may not be 40 hours per week, and maybe 10 hours that one employee does, whatever. You're still assigning it to a particular cost. And I know that for those of you who took Business 1180, you got much more in detail into this and talked about things like unemployment insurance and all that. And I don't want to get too far off on that, but I do want to mention the fact that it is important to know that it's not just an hourly wage and it's just a matter of taking the wage per hour times the number of hours. You've also got costs which are very much related to this and that are fixed in terms of dollar cost, as in the case of insurance, or vary with this directly, as in the case of payroll costs, payroll taxes. They are the same percentage, which means if pay goes up, those go up, pay goes down, those go down. Okay. So these are factory labor costs that are incurred in the production of some good, and we would inventory those costs. We would capture those costs. So as an example here with Wallace Company, they incurred $32,000 of factory labor costs in whatever it is that they're making here. So where does factory labor go? We simply put it into factory labor, which is an inventory account. So as a result, it goes into that, and it's eventually going to move its way over into more formal inventory accounts that are going to be inventory accounts that will eventually become part of finished goods and become part of cost of goods sold. And there's a reason why we're doing these steps right now, accounting for materials, inventory, and then in a second overhead. And it's because we want to sort of trace the source of these, the origins of these, and then be able to apply them to the job, then be able to inventory those, and to be able to account for the cost of the particular thing and do it in a very logical basis. Okay, so we talked about labor. We talked about materials. We talked about labor. Now let's get to overhead. Okay. Some of this you know or should know by now. So we talked a lot about Chapter 11. Types of costs are things which apply to the production area that is in the making of goods. Some of these are mostly indirect, like property taxes on the building, depreciation on equipment, insurance on the building. This would not be typically health insurance. The workers would be insurance on the building, any kind of repairs or maintenance to machinery and equipment or the structure itself. Anything, these costs which are mostly indirect, and we accumulate those in a manufacturing overhead account. And as we accumulate them, we eventually assign those to work in process, which is an inventory account. And by the way, why work in process exists as a standalone account is because as we are working throughout the year and when we reach the cutoff periods for accounting, financial reporting, we may have a lot of goods that are in process, and so as a result, their inventory, we've got these as work in process accounts, but the quarter may have ended, and we've got to do a reporting, or the year may have ended, and we've got to do reporting, and so as a result, work that's not done, the cost of those are all gathered and posted into work in process, okay? And posting is simply the process of recording and putting into accounts, and we're going to get to some specific examples of that here in a second. In this case, we're back to our Wallace company. We're still on the Wallace example. We've got what? We've got a number of different indirect costs that are being recorded here. Factory utilities at $4,800. Factory insurance, $2,000. Factory repairs, $2,600. Depreciation of $3,000 and property taxes of $1,400. These are all applicable to the particular job itself, and they're being applied to overhead. So as a result, these sum to $13,800. So we've got these costs so far on this job: $42,000 for raw materials, $32,000 for factory labor, $13,800. Okay, here's the thing. Maybe these don't apply to just one job. Maybe these apply to several different jobs, particularly raw materials. And think about this: raw materials, if you're a painting contractor, I would imagine they probably buy paint in gigantic quantities. And what they don't use on one job, they can use on another job, right? And the job supervisor may sort of sign out paint for a particular job and then sign back in, and it can be reused for other jobs as well. So raw materials are not applicable just to one particular job, but they are captured so that they can be assigned to inventory accounts, which capture the cost, and they're assignable to that particular job. And the same goes with labor. You've got workers who are available to work. Again, let's take the painting contractor. You've got workers, and it doesn't matter if they're full-time, part-time, doesn't matter. They're available to work in a number of different places. In fact, they may in the same day work in 2 or 3 different jobs, right? And there may be ways that we can capture, hopefully there are ways that we can capture their labor applicable to those jobs. And we're going to get a little bit more specific on that in a second. And the same goes with manufacturing overhead. These are just recorded costs. How do we know what they apply to? Well, we're going to talk about that. That's really the process here. This is why I really like the way they've taken this example and started really from scratch and say, okay, we bought some stuff. We bought some batteries and some very unimproved goods, and we're going to do things with them, and we're going to put them into accounts and watch what happens. So that's kind of where we're going here. Okay. So any questions so far about what we've done here with the Wallace Company example? Again, we're saying that they're applying job order costing to whatever it is they're producing. They've got these acquisitions of costs. Right now, we don't know what to do with them because we need to assign them to particular jobs themselves, which we're going to do. Okay. All right. So here's an example. This is one of the do-it breakaways that usually come up at the end of a segment of the module. So this company, we've got a company called Ringling Company that's got these following costs for the month. And so what we're doing is we're doing cost accounting. We're gathering costs, and we're bringing things current. Kind of a process of adjustments. Okay, we had raw materials purchases of $4,200. We incurred factory labor of $18,000. We had factory utilities of $2,200. Now, the way this is stated is interesting, and it goes to something we covered in accounting 1, and that is accrual accounting. Factory utilities are payable. Well, if they're payable, it means they've been incurred. It means the expenses have been recognized. So we've got to recognize them, right? We wouldn't create a payable until they're recognized. On the other hand, factory insurance that was prepaid has not yet been recognized, but in this case, it's expired, so now it is recognized. It was prepaid and recorded as an asset, because remember, prepaids or deferrals are those items which are paid ahead of time. We haven't yet incurred the actual expense, and insurance is the best example of these deferred items. A prepaid item. It can include other things as well, like prepaid airfare or deposits on rented equipment or whatever. So there are a lot of different things that could, but insurance is the classic example because it tends to be a fairly significant cost, and it's not really one that is optional, and it applies to pretty much any business. And insurance, as I've said before, is one of those unique businesses that you've got to pay for the good up front. Otherwise, the system doesn't work. So in this case, it was prepaid, but now it's expired, so we have to recognize the cost. We have expense recognition. And then depreciation of $3,500, okay? And so it says now, take these manufacturing costs and record them. So that's what they've done here. Different example, but raw materials, $4,200, boom. What do? We put it over to the raw materials account. Factory labor, $18,000, boom. $18,000 goes there, and then manufacturing overhead, all those three items go into it. Easy peasy, okay? Nothing particularly difficult. All we're doing is we're gathering costs together. And as we get going deeper into this course, we will begin to apply them to inventory accounts. And again, the main purpose of job costing is to find out what it costs to make a particular amount of output. Okay, if you don't know what the input costs are, how on earth do you price the outputs? And this is why accounting is such a critical course, and why business schools require, I can't think of any business school that does not require at least 2 semesters of accounting, financial accounting to sort of introduce you to these general concepts and accounts and how they work, and income statements, balance sheets, all that, but also cost accounting or through managerial accounting to know how we accumulate costs and how we recognize things, and also how we do internal reporting. The difference between cost and managerial accounting is managerial accounting will also take into account revenues. And as we get further into the class, we'll talk about examples of where we do directly match up revenues to costs to determine whether we should do something or not do something. Remember, managerial accounts are often tasked with what ifs, and those what ifs then become part of the reliance upon them. And as production gets more sophisticated and as cost recognition becomes more accurate, these roles are going to be probably more and more important. Okay, so any questions about the first module or the first section, learning objective in this module? Okay, let's go on to the second learning objective, and we're going to talk about how we record these costs using these job cost sheets, which may be physical in nature, but increasingly are becoming more recorded. And by the way, a lot of companies will use just a regular accounting software that does lots of things for them. QuickBooks is sort of the main, most popular software accounting for small business. It's made by Intuit. Now, as I understand it, something I just heard in a meeting the other day was they dropped the payroll package with that. So you've got to add that on. I think it's an extra cost to employers, but that was always a good value added, was you could include labor costs. And then I think all that would tie into the tax return preparation, which TurboTax is a sister, daughter, cousin, whatever you want to say, is a related software that you can upload that information into. My point is, though, that there is software that will do this for you, that you don't necessarily have to use actual physical documents. Some of the examples that we'll see here look like physical sheets, and I can imagine in some places physical documents are being used, but I don't see a good reason to do that. We are moving very, very rapidly, and in most cases are mostly paperless. I don't have very much paper that I deal with in my life anymore, and that's a good thing. It's a very good thing. I think I write 1 check a month even, for a storage unit that they don't take a credit card. So anyway, the point is that we record these things mostly electronically, but we will still refer to them as sheets. Okay, so these costs that we are talking about, where do they go? Well, they're going to go to inventory. We're going to say they're inventoriable, and until the product is done, we can record those in a work in process account, which is inventory account. Okay, it's balance sheet account, and we don't recognize expense of production, even indirect production or direct cost of production, like indirect materials, indirect labor, until the good is sold. Instead, we inventory them. So as we're accumulating these costs, we're putting increases to work in process, and we're decreasing those accounts we just looked at: raw materials, factory labor, manufacturing overhead. And as I noted here, the green typing is my own. I said these production costs are absorbed into inventory. That sounds like a goofy term. I didn't make it up. It's called absorption costing. They're absorbed into inventory as the product moves along the chain of product toward completion. So those inventory accounts are growing as we're accumulating costs. And what we're going to do here is we're going to say that, okay, this business, whatever this business is not just doing one job, they're doing several jobs. And so these purchases, these acquisitions of cost, again, as I mentioned a minute ago, can apply to different jobs. And it's our job to allocate them now to inventory, okay? And that process is simply called assigning. So one document or spreadsheet or whatever, or physical record or electronic record or physical record is job cost sheet. A job cost sheet at one time used to be a physical document, and oftentimes it used to be carbonized. You have a white copy on top, a pink, a yellow copy. They go different places, and then further down in that carbonized stack, the harder it was to read. And I think a lot of carbonized documents aren't really used as much anymore, but today we can reproduce electronic documents, at our heart's content, and upload all this to the cloud in many cases. Certainly QuickBooks can allow us to do that. Other software, Sage, NetSuite, all these are able to do this for us. And sometimes there is software construction. This construction industry has long had software that's dedicated to the unique needs of construction companies. So I'm not trying to advertise particular brands of software. I'm just simply saying there is software that does a lot of different things for a business, and to the extent they can rely upon technology, that's all the good for them. So on a job cost sheet that we're capturing costs applicable, these costs are applicable and chargeable to a specific job itself, okay? And then we introduced a term called subsidiary ledger, okay? And first of all, let's define what a ledger is before we get into subsidiary ledger. A ledger is simply a record of cost, usually. It might include numerical things and things that are counted like labor hours and whatnot, but it's typically counting dollar figures. And it's not really that much different than the ledger that you might have on your checking account, where you've got money in, money out, and a balance. It's the same kind of concept. And a subsidiary ledger will be anything that folds into that. There may be many subsidiary ledgers that fold into another account. As an example, let's just take something like accounts receivable, which is what we call a ledger account. That's a balance sheet account, but it's a ledger called accounts receivable. And within that, you may have several thousand customers that owe you money that we would call subsidiary ledger. So P&M, for instance, most of us have a P&M account, and they probably have one giant ledger account called accounts receivable. And many, I don't know, tens of thousands, hundreds of thousands, I don't know however many individual accounts of customers owe them money, which is what a receivable is, where a customer owes you money, and those would be subsidiary ledgers, okay? So it's not just accounts receivable, it could be inventory, it could be all kinds of subsidiary ledgers. They simply add up and fold into that broader, bigger sort of master account, okay? So these accounts that we're charging to these particular jobs will each have their own subsidiary ledger. So one for each particular job will have that, right? Or at least one. And here's an unfortunate entry here. I know that the textbook tried to erase and edit out the reference to debits and credits. And in this class, and also in 2110, we had chosen not to discuss debits and credits. Debits and credits are simply the way that we raise or lower individual accounts, including subsidiary accounts. And debits don't mean increase or decrease. Credits don't mean increase or decrease. I know it confuses people because we all refer to debit cards and credit cards. And the terms debit and credit are simply nominal terms that are simply applied. We could say A or B. We could say North Pole, South Pole. It doesn't matter. They don't mean anything. But in this case, this sort of slipped through the net of the publisher Wiley, and I just went ahead and said, okay, a debit entry is an increase to a work in process. A debit to an asset is an increase. So as we're accumulating costs here, we're increasing the work in process count because it's an inventory account, right? And then hopefully there's some sort of supporting job cost sheets. And in accounting parlance, we refer to these as one of a giant category of things we call source documents. Accountants love source documents because it allows us to go back and find out what has gone wrong. Particularly if numbers aren't balancing, they're not jiving for whatever reason, we got to go back and look at the source documents, which again may not be a physical document, but sometimes they are. And we call those source documents. And we use everywhere in accounting, we use those. Well, even in auditing and also in tax. I know certainly in I don't have an auditing background, but I do have a tax background. We are all the time scrounging around for source documents that we need because we are unable to figure something out or whatever. And accountants are nothing if not problem solvers. So as a result, these job cost sheets should document and support the recognition and the posting to those particular inventory accounts. So an example will look like this. This is a very generic example. It's in your slide package. And a couple things on here. I don't want to spend a lot of time on it because it's not really that critical, but it's, you have a job number here, you got some dates, and you've got what these things constitute. Are they direct materials? Are they direct labor? Are they manufacturing overhead? And then to the extent that you can add these up here, you can assign these to particular jobs and even assign a particular cost if need be. Not all these, this is not exactly a standardized form, but it's just an example of what you might see when it comes to accumulating costs of various kinds of things. And we've also got ones that are unique to raw materials. When it comes to raw materials, we often have what's called a requisition slip, which may or may not be a physical document. But one thing that is necessary here is that when materials are accessed for whatever reason, remember it's the paint contractor who needs 2 5-gallon 5-gallon buckets of paint in order to do a job, and they go to the warehouse and check out 2 5-gallon buckets. If they don't use it all, they can return it. Somebody else can use the rest. And I know that, and I've spent a lot of time around construction companies, I know that they're not exactly the best record keepers for who's checking out materials, things like drywall and screws and lumber and paint and all that sort of thing. So, but to the extent that they can and should, it's not my job to say what people should do, but they should, if they want to get good record keeping, is that they should be able to authorize these. Somebody should authorize them, a supervisor, theoretically, or somebody who's a senior person, and then assign those directly to the job itself. And by recording those as part of direct materials. And raw materials tend to be direct materials. They could be indirect if they're very, very incidental, things like tape and whatnot. So, and I can well imagine a painting contractor might just say that tape that is used to tape around borders is very much an indirect item. It's really difficult. I mean, you could say direct materials, but I don't know that it really matters at the end of the day, particularly on something that small. But you get the idea. Whatever is going on, we should be able to capture the cost. And then when it comes to indirect materials, we would put those as to manufacturing overhead. That's the only difference is if we are putting in direct materials, raw materials go to direct materials, it goes to that category in work in process. Otherwise, it goes to manufacturing overhead for a time until it itself works its way into work in process. That's why it's maybe not that critical of a distinction if the dollar amounts are small. And remember, a lot of times the whole purpose of manufacturing overhead as a category of cost was the difficulty and, in some cases, the irrelevance of certain costs. We want to account for them, but we don't have to necessarily get to that extreme of bean counting. Okay. So here's an example of a materials requisition slip. And again, I don't want to spend a lot of time on it. It's just a generic example. It could be all kinds of other examples. The key things I want to point out are individual job numbers, and to the extent that companies are assigning job numbers to unique tasks, it may not be a customer number. And this is one thing that I think we should be clear on, is that sometimes we will have a customer number for all the customers we've ever done business with, and we almost never, even if we have not done business with them in years, they're still there. There's no reason not to have them. But that's not a job. And that same customer may have 4 or 5 different jobs, and they all have different numbers. And if you want to link them to the customer, you can add a tag, either prefix or suffix to this. But you've got to have a job number that's unique, that's recognized by the system, so that you can be able to capture these costs and put them in there. That's the one main thing there. And then the other is this idea you've got different parties involved and someone to approve it. If it's a small business, clearly you're not going to have this formal, very often this formal of a process. But in bigger businesses, you are going to have this big of a process. And even areas where you're producing things and you want to capture the cost per job, some of these inputs are not small in nature. And so as a result of this, some of this material is expensive, and so you want somebody to approve it so that you know how much is leaving the warehouse, leaving the dock, getting on a truck, because you don't want that to go and be stolen or misdirected or whatever, and you want to know where it is. And so accounting for inventory is an important part of this nature of something we talked about in accounting one. It's called control. And accountants are sort of, I guess the wrap on it is they're sort of control freaks. We use the term internal control as being this idea of accounting for things, which is hence the term of this discipline, but also financial control, inventory control, they're all part of the same idea. Okay, so that's an example of that. Now, let's go back to Wallace. Okay, remember that we had these costs. We had 42,000 of acquired raw materials. We incurred 32,000 of labor, and we have incurred, whether it's been paid or not, doesn't matter. We've incurred manufacturing overhead of these costs. Okay, now we go back here and we've got the fact, here's the scenario that Wallace has now used for 24,000 of direct materials and 6,000 of indirect materials. Remember, these raw materials can go off into two different places. Usually indirect materials are almost always a smaller portion of materials cost than direct materials for obvious reasons, just the nature of those materials themselves. And so in this case, 24,000 of direct materials and 6,000 of indirect materials in the month of January. So it's going to reduce them by 30,000. 24 plus 6 is 30,000. So, but here's the thing. We're going to take the direct materials and we're going to dump that into work in process. Boom. It goes straight into inventory. In particular, a subsidiary ledger that matches the work in process for that particular job. But we'll get to that in a minute. Right now, we don't really care. As we assign these to particular jobs, we will make this a little bit more clear. But all we know right now is that we have taken 24,000 and it becomes direct materials. So it goes into work in process. But here's the thing. The indirect materials go into manufacturing overhead for right now. And at some point, as we accumulate costs to manufacturing overhead, we will assign those to individual jobs themselves in work in process. But it's a little bit trickier when it comes to manufacturing overhead because remember, in the case of indirect materials, that's a little bit easier, but some of these are not indirect materials at all. They're things like property taxes and depreciation on equipment. A lot of companies have trucks that move things around, forklifts, and how do you put those costs on individual products if you want to be completely accurate? That becomes somewhat difficult. So, and that's kind of the trick here, okay? All right, so that's the first set of transactions that we're looking to recognize cost and to take these recognized costs and to put them in inventory. But for right now, this is sort of pending and sort of temporary, okay? We're going to talk much more about overhead here in a second. Okay. All right, and this is what these look like in terms of general ledger and subsidiary ledger. All a general ledger is a sort of master account that is the sum total of increases and decreases in subsidiary accounts. So in this case, let's go back here. And I know this is maybe hard to see if you're watching on your own screen, and certainly in the classroom, it's a little bit hard to see, but you can sort of match this up. But remember, you've got 24,000 of work in process now. Okay, and oops, I went in the wrong direction. Work in process. 24,000 work in process, which we then record in the general ledger in work in process inventory. We also had a bunch of other things. We had some raw materials and whatnot. So, and notice this: if you take all these together, here we have 12,000 of these direct materials that go to job 101. 7,000 go to job 102. That's 12,000 plus 7. I'm just adding these columns here: 1,000, 7,000, 4,000, 12,000. Add these up. That's 7,000 to job 102, 5,000 to job 103. 12,000 plus 7,000 plus 5,000 is the 24,000 that we recorded as materials applicable to certain jobs coming out of raw materials. And so we've accounted for those fairly nicely. Those initial batteries are one of those acquisitions that were included in that 24,000. So in this case, what we've done is we've taken this good all the way, and we're saying it's a direct material. We're saying these batteries are integral to whatever it is that we're doing. We started with these $1,000 of batteries we brought in, we eventually, and we put them in direct materials, and we eventually assign them to a particular job, because they're all going to be used in job 101, whatever job 101 is, okay? And so we're allocating these to individual jobs themselves, okay? And what are these subsidiary ledgers of? If they're subsidiary to something, they're subsidiary to what? They're subsidiary to work in process, okay? Work in process is the inventory account that captures goods in the process of being made. It is a cost capture account, okay? But it's an asset account because we haven't recognized these costs in terms of expenses yet. All we've done is simply capture them and posted them into inventory because we don't recognize the cost until the good itself is sold. So we're in the process of doing that. And notice, one thing I like about this, even though I know this is kind of a busy screen, I get that, but it recognizes the fact that there are a lot of different jobs going on at once, and a lot of times drawing from the same common pool of materials and labor that have got to go different places. And to the extent that we can allocate those to where they're specifically being used, the better we can arrive at the cost for that particular task or project or job, okay? So that's materials. Any questions so far about what this is about? Because I know this has got multiple separate things going on here. I know it's kind of busy. I know it's kind of hard to see, but this example is in the text itself. And just really pay attention to this and notice what's going on. And don't be, overwhelmed by or intimidated by the number of different line items here. If you just simply take one at a time and study what's going on, it sort of makes sense over time, okay? All right, so all these costs together, the 12,000, 7,000, 5,000 summed up, and they go into work in process, capturing those costs. All right, so that's materials. What about labor? Okay, so factory labor, again, and we talk about time tickets here, and I know hourly employees are the ones who fill out time sheets, time slips, time tickets, punch cards, whatever. Punch cards are maybe a thing of the past in some places, I don't know, but traditionally that's the way that workers who are considered non-exempt, that is, they're not exempt from time reporting, they have to report their time. They would record their time, punching in, punching out. But it's more than that, though, when it comes to job order costing. And beyond whether or not companies actually have punch cards or not, a lot of companies will have people report in to work if they're capturing their time. And some companies do a better job of accounting for it, some don't. Even a lot of hourly employees who are supposed to be there from 8 to 5 with an hour of lunch, if they get there at 8:10 and leave at 4:50, it's usually not that big of a deal. Particularly when it's in the employee's favor. If there's overtime, then that becomes a bigger issue. So there are lots of ways to do this. I know some companies will have workers increasingly sign in with their cell phones. There's a little app on their phone, they just simply punch in. And what's interesting, I know my wife's company has an app where workers show up into a particular job, they move around, different locations, maybe different hospitals. And as they do it, when they sign into work on their cell phone, and the cell phone captures where they physically are so that they can attach to the job itself. It's pretty good. So to the extent that technology can do the job for us, all the better. We want to get out of doing physical labor, right? So if we can possibly do that. Not that there's anything wrong with physical labor, but if we can save time, it's all to the good. So time tickets or whatever the medium is by which we record the time, all this is captured, and sometimes employees use swipe cards. And they'll swipe in, swipe out, or they'll sign in, sign out, or their label will be attached to it. Again, smaller businesses may not have quite the systems and sophistication to do that, but it would behoove them to try their best to do it, particularly if it's where they've got multiple different jobs and they're assigning different amounts of labor to it. And I don't mean to be critical of small businesses because some do a very good job. I think a lot of auto repair companies do a very good job of capturing labor because it's really part of the way that they price the good in the first place is they mark up their labor costs, and why not? That's what they're there to do. So however it's done is the way that we attach cost, an internal item, to the pricing of the goods that we can, if possible, maximize that distance. And so if they can swipe in, swipe out, sign in, sign out, whatever the case might be. So This is just an example of a time ticket. I don't know if there's anything too interesting here to look at, but here is the thing that it is interesting, I guess, and sort of relevant is this idea of what we do with these costs. Let's not worry about the term journal entry. The book needed to probably do a better job of sort of scrubbing these terms, which are mostly going to be applicable to those who will be accounting majors. Accounting and finance majors will take further courses in which we'll get into things like journal entries, but all they really are is simply reporting information into accounts. And so in this case, what do we got here? We had for labor, we incurred $28,000 of direct labor. Now, where did that number come from? Well, we go back here to this thing here, and we said that we had 32,000 of labor incurred, okay, for this time period that we're now going to try to inventory. So of that 32,000, we're saying that 28,000 is direct labor and 4,000 is indirect labor, okay? The 28,000 direct labor that is directly applicable to specific jobs and immediately applicable, we go ahead and put it in work in process. The 4,000 indirect labor, when we talk about what indirect labor is, for right now is going to be pending in manufacturing overhead. We're going to record it there before we move it over to inventory, okay? Notice where we had the starting balance of 19,800. We had actually started this whole thing, and I know I'm flipping back here, but I want to refer. We start out with manufacturing overhead, actually goes back 13,800, okay, initially, because we had things like utilities, insurance, and whatnot. Then we ended up picking up 6,000 more through indirect materials, and that's 19,800. Now we've got 4,000 of indirect labor. So we had started with 13,800 and things which are very indirect, like property taxes, depreciation. We had 6,000 of, that was 13,800. We had 6,000 of indirect materials. Now we got 4,000 of indirect labor. So now as a result, manufacturing overhead is growing to 23,800. And we will talk about what to do with that because we want to move that over to work in process. And we'll do that. We'll get to that particular process of doing it. So what's really going on here is the idea that we are simply capturing labor costs and we're inventorying those costs to the extent possible. So this is the process of cost absorption and eventually assigning to specific jobs, okay? And in this case, let's go to the job cost sheets, which are simply records of cost accumulation. And we all these time tickets or whatever, however we record the time. And again, for non-exempt employees whose time has to be recorded. Now, remember, if you've got salaried employees, they're exempt employees, they don't have to record their time. Typically, their cost is an indirect cost. It's indirect labor, and they would go into manufacturing overhead. Supervisors, for the most part, who are paid on salary, whether they work 30 hours a week or 70 hours a week, they're paid the same amount. That's what it means to be exempt. You don't have to record your time, and so as a result, it's really difficult too to record their where they're spending their time, and you know we don't slice it that finely, and so we put it into overhead because it needs to go somewhere, and but we can do our best to estimate that, and we're not going to be able to get to that today. But we will get to that on Monday. Okay, the last thing is we want to sort of finish this up, and then it'll be a segue into the next segment. So we got all this. Times that all these hours and times and hourly wages, all which are different hours, different wage rates, all this kind of stuff. And then we can include in it things that we want to include in terms of benefits costs, payroll costs, whatever. If we're very good cost accountants, we'll do that. So in this case, we incurred what was it, 28,000 direct labor, of which 9,000 goes to Job 101 on January 10th. On January 31st, another 6,000. On January 15th. Job 102 gets 4,000, January 22nd, 5,000 goes to job 102, these are different jobs. Job 103 gets 4,000 on 129. If you add these up, 15,000, 9,000, that's 24,000, plus 4 is 28,000, all of which then go into where? Go into work in process. Work in process, again, is the account that captures these costs as these goods are being worked in process. Money goes into work in process, or I should say accounting entries go in there. They go in and they go out, in and out. They're not, this is not an account like a building, you buy a building for 500,000, that building stays on the balance sheet as an asset account for decades. That's not what a work in process does. Remember, it's a current asset account. Those current assets move. And that's why they're called current assets. They're changing, they're converting themselves to cash, they're liquidating themselves, they're moving on. Okay? So this is what's pending right now. We've had to pay these workers, obviously. These are not cases in which we accrue these and don't pay them. But that's not really relevant to when they get paid and when they don't get paid. When they've been incurred is when we recognize them, and we recognize them by, again, the term capitalizing those, by putting those into an inventory account. Okay. So that's the direct labor piece of this. Now remember, we had 4,000 of indirect labor that we put in manufacturing overhead. We won't forget about that. We'll come back to that. Unfortunately, we don't have too much time to do that. And I know it's sometimes you get into the middle of these things and you wish you had more time. I just don't have time. I've been running over as it is anyway. So we won't forget about that. We'll come back to that here a bit later. One final bit here is there's an example here as we end this particular learning objective in the module. As we got a different example, Danielle Company has two job orders, job 120 and job 121. We get direct materials, direct labor, all of which, as I've noted here, are inventoriable costs. And we take that 6,000, 3,600 in direct materials, which should be 9,600, boom, direct materials, 4,000 and 2,000, 6,000 into factory labor, all of which, because they're direct costs, oops, I erased it, all of which move into work in process because they're direct. Indirect costs then will work their way into manufacturing overhead, okay? And raw materials is usually associated with direct materials or direct costs, but because some of these are incidental and difficult to trace to a particular product, which is one of the definitions of overhead for indirect materials, we will put that into overhead account to begin with. So, okay. All right. Well, I think that's about all. Does anyone have any questions for me before we wrap this up today? And I want to make sure that I'm still recording, and I am. Okay. Well, if you do have questions, let me know. Again, there's nothing due this weekend for Chapter 12, but you do want to complete Chapter 11 if you have not done so yet. And if you have questions about that, I should be available all weekend in order to answer your questions. So feel free to email me. It's probably the best way to reach me, unless you happen to be around me in campus, in which case I'm there afternoons. So if nobody has any questions, then we'll say goodbye for today. Have a good weekend. See you on Monday.